In today's episode, I'll talk about two interesting stories. In the first story, I'll start from where we left off yesterday and discuss whether or not the RBI will cut interest rates after the US Fed cut interest rates just yesterday. And in the second story, I'll talk about India's increasing trade deficit and what it really means. Welcome to the Daily Brief show by Zerodha, where our goal is to cover news in a way that is one level deeper as compared to regular news channels. I'm your host Anurag Bansal. Today is Friday, the 20th of September, and let's start with our story. In yesterday's episode, I discussed the possibility of the US Federal Reserve cutting interest rates and why it matters not just for the US, but for economies around the world, including India. As it was expected, the Fed made its move. For the first time in 4 years, the US Fed cut interest rates by 0.5 percentage points. The Fed is doing this because the US labor market is slowing down, inflation is cooling off, and the Fed wants to ensure stability in the country. Fed Chairman Jerome Powell said,
"The US economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there."
Now, all that is okay, but the bigger question is, why does all of this matter to us in India? See, here is the thing. When the Fed makes a move like this, it creates ripples. The US dollar is a big deal globally, and anything that affects its value kind of ends up affecting everyone else too. Closer to home in India, the RBI usually takes its cues from the Fed and alters interest rates like we discussed yesterday. But that does not mean that they will always immediately follow the Fed. There are a couple of reasons for this, and it is important that we know and understand it as investors. Let me explain this by telling you the immediate impact if the RBI does not follow the US Fed's lead. First, it will lead to cheaper imports. See, if the RBI keeps interest rates high and the Fed lowers theirs, the rupee could get stronger against the dollar. A stronger rupee means that things like oil, electronics, and machinery, which is basically all the stuff we import, becomes cheaper. Now, I know you might think this is positive news, but the catch here is that cheaper imports means that we end up buying more from countries abroad. This puts pressure on our foreign exchange reserves. The second effect is expensive exports. See, a stronger rupee also means that Indian goods become more expensive in global markets. For exporters, this can be a significant challenge. When our goods are priced higher, the demand for them naturally falls down. Now, this decline in exports can hit employment in export-dependent sectors like textile, agriculture, and IT services. These are sectors that provide large-scale employment, especially in rural and semi-urban areas. Now, the RBI's main job is to keep inflation in check. They, of course, care about the rupee as well, but their priority is to ensure that prices do not spiral out of control. Right now, while the overall inflation is within RBI's target range of 2 to 6%, food inflation is still a problem. Therefore, RBI might just hold off on cutting rates this time around. SBI Chairman C.S. Shetty also said something very similar. He said, and I quote, "While the Fed rate cut would influence everyone, the RBI would be mindful of food inflation before taking a call on interest rate cuts." So in summary, the RBI has a very tricky decision to make here. The Fed has cut interest rates, and that is definitely going to have a ripple effect. But the RBI has to consider many factors, from inflation to the value of the rupee to the health of our exports before they can make any decision. And that is because at the end of the day, it is all about maintaining a balance for the RBI. Their next move in the coming few months will very significantly shape India's economy, so it'll be very interesting to track what happens. Now, moving on to the next story of the day, let's talk about India's rising trade deficit and what it really means for us. See, India's trade deficit, which is the gap between our import and exports, recently widened to the highest level in 10 months. In August 2024, this deficit number hit around $30 billion US dollars, which was driven primarily by a surge in gold imports and weakening exports. To give you a point of reference, economists had expected this trade deficit to be around $23 billion. So the 30 billion figure is almost 1/3 more than what experts had predicted. So in the first go, all of this might sound a little alarming, but it may not be as alarming as you think in reality. And let me explain this. See, the trade deficit that is being talked about here is specifically the merchandise trade deficit, which is only related to the trade of physical goods and does not include the trade of services. If services are considered, the overall trade situation completely changes because India has a 15 billion US dollar trade surplus in services. But that said, there is something definitely happening here which is interesting to know and understand from an investor's perspective. So let me dive into the details of why gold imports have spiked, why overall exports are following, and how the global economy is playing a critical role in shaping India's trade picture. I'll also try and explore what this trade deficit means for India's economic strategy moving forward and what solutions can be provided here. Let's start by first understanding why merchandise deficit is widening in the first place. See, the biggest driver of this deficit this time around is gold. Imports of gold surged to over 10 billion US dollars, which is 3 times the monthly average earlier this year. The reason for this spike is that there was a recent reduction in import duties of gold from 15% to 6%. There is also the festive season demand in India, which is coming up soon, and this is causing traders to stock up on large amounts of gold while the prices are low. But the good news here is that if August has seen a massive surge in gold imports, imports might moderate in the coming months. Another reason is China's economic slowdown. By this time, I'm sure all of us watching this know that China's economy is struggling. See, while China continues to produce goods at scale, its domestic consumption has slowed down significantly due to internal economic struggles. So, a lot more of what China manufactures has to be sold outside of China now. This has led to an oversupply of goods, which China now exports at dirt cheap prices. These cheap Chinese goods are flooding the global markets, and it is making it very difficult for Indian manufacturers to compete. As a result, India's exports are struggling. The other reason is global supply chain disruptions. See, freight costs have skyrocketed because of global supply chain bottlenecks. A key reason for this is the disruption in the Red Sea and Suez Canal. Normally, this route serves as a shortcut between Asia, Europe, and the US, but disruptions have now forced ships to take a longer route around Africa, which has added significant costs and time to shipments, affecting Indian exporters. But now the question is, how can all of this be addressed? See, as you would already imagine, these are very, very complicated matters to handle. But still, let us take a look at a few ways that could help. First is expanding domestic production. Probably the most sustainable way for India to tackle this merchandise trade deficit is to strengthen domestic manufacturing. The government has already pushed initiatives like Make in India and the Production Linked Incentive or PLI scheme, and has spent a lot on improving India's logistics infrastructure. Despite this, however, if we still have persistent difficulties in improving this deficit, it might be time to rethink our policies around manufacturing and foreign trade more holistically. The next potential solution is counterbalancing merchandise deficits with services surpluses. See, our balance of payments does not just depend on bringing down our deficit in manufacturing. We can look for other ways to bring in money to our country as well. Services, for instance, are India's strong suit. We have global capacity centers which export services across the entire world. The more we increase these service exports, the more easily we can tide over a high merchandise trade deficit. The next solution is drawing more foreign investments into India. See, another way more money can enter our country is through investments. Currently, the amount of foreign investments into India is falling despite many countries looking for alternatives to China. If we could somehow find a way to draw in more of this investment, it will bring two benefits to us. First, it will improve our balance of payment situation that we have today, and second, it will improve our manufacturing ecosystem in the long term. So in conclusion, while reading the news of India's widening trade deficit could seem alarming at first, it is important to keep the bigger picture in mind. Also, India's foreign reserves, which by the way are at the highest levels ever right now, provide a buffer against short-term shocks. But that said, the key to long-term stability in India is to improve our overall trade economy. The last severe balance of payments crisis we faced was in the 1990s, where the solution was to open up and liberalize the economy. Even though the current case is not severe as such, maybe there is a thing or two we can look to learn from the previous experiences. Now let's move on to the last section of the day, which is the small pieces of tidbit news. First, India has recently approved a 20,000 crore rupee budget for ISRO space projects like the Gaganyaan human spaceflight, a new moon mission, and a mission to Venus. This money will help with research and get more private companies involved in space research. Second, Zee Entertainment is currently in a legal fight with Star India over a 1.4 billion US dollar cricket broadcasting deal that Zee pulled out of. Star India is asking for 940 million US dollars in damages. Third, Alibaba launched over 100 new AI models to compete with companies like Baidu and Microsoft. They also recently introduced a tool that lets users create videos by just typing a single prompt. Fourth, Binance recently accused WazirX and its founders of misleading customers about their relationship after a 230 million US dollar hack. Binance said that it never owned or controlled WazirX and called on WazirX's parent company to compensate users. That's all the news and stories I have for you today. I hope you found this episode valuable and informative. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.